Let's start with the basics. So, you've heard about trading. Maybe you saw a movie where a sharp-suited character made a fortune with a few clicks. Or a friend mentioned buying stocks and you got curious. What is trading really? At its core, trading is the act of buying financial instruments and selling financial instruments. Stocks, Apple, Tesla, currencies, commodities like gold, cryptocurrencies. The goal is simple: buy low and sell high. Like buying a collectible for $10 and selling it for $20. $10 profit. Why do people get into trading? Financial freedom. But trading is not a get-rich-quick scheme. This guide cuts through the noise to give you a simple, actionable starting point. Let's get straight to the point. The strategy we are going to learn today is called the moving average crossover. Don't let the name intimidate you. The concept is incredibly simple and powerful. A moving average is one of the most popular technical indicators used by traders. It helps to smooth out price data into a single flowing line. Think of it as the average price over a specific period. For example, a 20-period moving average shows the average closing price of the last 20 trading days. This filters out daily noise so you see the trend. The crossover is where the magic happens. We use a fast-moving MA and a slow-moving MA. 20-period moving average, the fast one. 50-period moving average, the slow one. The fast MA reacts quicker, the slow MA shows the longer-term trend. A trading signal is generated when these lines cross. When the 20 crosses above the 50, it is bullish, a golden cross. It suggests momentum may be shifting upward. Consider buying. When the 20 crosses below the 50, it signals weakness, sometimes called a death cross. The beauty is simplicity and objectivity. You follow a clear visual rule, not gut feelings. This mechanical approach is the foundation of consistent trading. Before we dive into the strategy, we need to build our vocabulary. Understanding basic trading terms is non-negotiable. First up, the stock chart, a graphical price history. Most traders use candlestick charts. Each candle shows open, high, low, and close for the time frame. Green typically means price closed higher. Red means it closed lower. This gives a quick sense of price action and sentiment. The moving average, our main tool, is a trend-following line. It represents average price over a set number of periods. A bull market is when prices generally rise, higher highs, and higher lows. A bear market is the opposite, lower highs and lower lows. A range-bound market moves sideways between support and resistance. Crossover strategies perform poorly in choppy markets. Remember that limitation. Our 20 and 50 MAs will help spot trends when they exist. In an uptrend, price stays above the MAs, which act as dynamic support. Reading charts is about locating where probabilities lie, not perfect prediction. Looking at a stock chart for the first time can feel like a foreign language, a sea of lines, colors, and numbers. But once you know what to look for, it becomes much clearer. The most important skill is identifying the trend. Markets move three ways: up, down, or sideways. An uptrend shows higher highs and higher lows. It looks like ascending steps. A downtrend is the opposite: lower highs and lower lows. Rallies fail to reach prior peaks and reverse. Ranges bounce between support and resistance. Trend tools give false signals here. Moving averages spot trends more easily when price is trending. In healthy uptrends, price will usually trade above both MAs. By spotting these patterns, you stop guessing and make evidence-based decisions. Keep things simple: trend, confirmation, trade. Now that we understand the strategy and how to read a chart, let's find our entry. The primary buy signal is the golden cross. That's when the 20-period MA crosses above the 50-period MA, the 20-period MA, and the 50-period MA. Do not buy the instant the crossover happens. Sometimes the lines cross then cross back. False signals in choppy markets. Patience. Wait for confirmation. A good confirmation is price showing strength after the crossover. Often wait for a small pullback to one of the MAs. A bounce off the MA is a cleaner entry than chasing the first crossover. Buying the bounce gives a better price and clearer trend confirmation. Step 1. Identify the golden cross on the daily chart. Step 2. Confirm both MAs are pointing upwards and price is above them. Step 3. Wait for a trigger. Price touching the 20 MA, then a strong green candle. Only hunt for buys when the market context is favorable. Do not force buys in sideways, messy environments. This filtering reduces low-quality signals and raises your odds. Follow the rules. You capture better, higher probability trades. A real chart example: NVDA late 2022 to early 2023. At first, NVDA was in a downtrend, price below both MAs. Price trading below the 20 And below the 50, no buy. The 20 was firmly below the 50. Stay on the sidelines. In early February 2023, the 20 crossed above the 50, the golden cross. Bearish momentum eased and buyers started stepping in. We don't buy immediately. We wait for confirmation. Price pushed higher and both MAs angled up. Confirmation. The ideal entry came a few weeks later on a pullback to the 20 MA. A large bullish candle signaled buyers were back. That was the trigger. That would have been an excellent entry. From there, NVDA started a powerful multi-month rally. It made higher highs and higher lows, hold while trend intact. The MAs gave a clear guide to trend health. A trader following the system would have ridden a big portion of the move. A textbook example of rule-based trend following. It filters out day-to-day noise to capture large moves. Simple rules, applied consistently, win over time. Protect your capital. The non-negotiable rules of risk management. Strategies are useless without risk control. The first rule is not make money. It is protect your capital. Without capital, you cannot trade. A beginner-friendly rule is the 1% rule. Never risk more than 1% of your account on a single trade. If you have $5,000, 1% is $50. Use stop-loss orders to cap your loss automatically. A stop-loss protects you from runaway losses. Place stop-loss below a logical support level. Recent swing low or below the 50 MA. This gives room but defines max loss. Example, $5,000 account, stock at $50, entry $50, stop loss $45, risk $5 per share. Divide $50 by $5, risk per share, equal sign by 10 shares. If stop hits, you lose exactly $50. Controlled risk. This mechanical risk approach keeps traders solvent. Controlled small losses allow you to survive for big winners. You can be wrong half the time and still profitable when winners are much larger than losers. Protect capital first. Profits follow. If you are serious about improving, keep a trading journal. This is not optional. For every trade, log the date, the ticker, whether it was a buy or sell, your entry and exit prices, stop loss and target. Include a screenshot of the chart at entry and annotate why you took it. Mark the moving average crossover or support bounce. Visually capture the reason. Record your reasoning and emotional state before the trade. Were you confident, fearful, or greedy? Write it down. After the trade close, note what you did well if it was a winner. If it lost, analyze whether you erred or it was a valid setup that failed. Over time, your journal reveals patterns. Which stocks and setups work for you? Calculate your win rate and risk to reward to measure edge. This data is priceless for turning trading into a business. A disciplined journal transforms guesswork into repeatable processes. Use lessons from the journal to refine your plan. Honest review beats motivation. Journal consistently and improve steadily. Your journey starts now. Small steps to big wins. We covered what trading is, a step-by-step moving average crossover strategy, and risk management. Practice the strategy in a demo account first. Paper trade live markets with virtual funds, your sandbox. Execute at least 50 demo trades using this method. When ready, trade live. But start unbelievably small. A tiny real account teaches psychology you cannot simulate. Real money feels different. Manage emotions, not just strategy. This is a marathon, not a sprint. Core rules: trade with a plan, use stop losses, manage position size, journal everything. Stick to the plan and manage risk religiously. Never stop learning. Refine the strategy as you gain experience. This is a starting blueprint. Adapt it into your own trading business. Take the first small step today. Open a demo account and start journaling. Begin with patience and discipline. Key takeaways: simple rules, protect capital, practice deliberately. Subscribe for more practical trading guides. Thank you for watching New Blueprint FX, your partner on the path to trading mastery. If you found value in today's video, don't forget to hit that subscribe button, ring the bell so you never miss a trading tip. Like this video, if you're ready to take control of your financial future, share it with friends who are starting their trading journey. Have questions? Want to share your progress? Drop a comment below. We love hearing from you. Remember, every trader's story starts with a single step. Let's grow together right here on New Blueprint FX. See you in the next video.